Welcome back to the Deep Dive. We're here to turn complex financial reports, corporate news, into clear, usable knowledge for you. Today, we're really immersing ourselves in aquaculture, specifically Avanti Feeds Limited. That's Avanti Feed on the ticker. We've got their latest Q1 FY26 results. That's the quarter ending June 30th, 2025. And we're layering that with, well, some pretty crucial recent strategic moves right up to October 2025. Okay, so let's unpack this. The raw data. It suggests some, powerful recent momentum. But our goal today is to look beneath the surface. We want to figure out exactly where the strength is coming from, which segments are pulling the weight, and importantly, how their latest strategic moves are positioning them for the future, maybe even mitigating some risks we see in these numbers.
That's a great way to frame it because, yeah, the first glance at the Q1 results shows this phenomenal profit growth, but you absolutely have to peel back the layers to see what's happening in each business segment. And we start with the big picture, the consolidated numbers for Q1 FY26 versus the same quarter last year. They look structurally quite strong.
All right, give us the headline figures, but let's try to understand the relationship, between the revenue growth and that really big jump in profit. What's the dynamic there?
Okay. Starting with the overall size consolidated revenues, they grew a solid 6.9% year over year. That brings them to RRS 16,064 million. But here's where it gets interesting, the puzzle you mentioned, the profit after tax, or PIC. That grew way faster. It accelerated by a massive 35% year over year. We're talking RRS 1,857 million in profit.
Wow, okay, 35% PE growth on less than 7% revenue growth. That does point towards some serious operational leverage or efficiency gains, doesn't it? So how about EBIT? Earnings before interest and tax? Did that show a similar jump?
It did, and that's exactly where you see the efficiency story. EBIT climbed 37.8% year over year. So this suggests that while their overall sales volume didn't explode across the board, the sales they did make were much more profitable. Either costs were managed better or the mix shifted. And what's really fascinating, kind of a key detail here, is that this EBIT surge got a big boost from other income. That line item jumped 45.9%. So this, let's call it an external boost, definitely helped push that net profit margin up to a very healthy 11.6% for the quarter.
And for our listeners tracking the fundamentals, the bottom line impact of all that improved margin is pretty clear, I imagine.
Absolutely clear. The direct benefit to shareholders is tangible. EPS, earnings per share, grew by 39.1%. It hit Rs 13.1 per share, which is way up from Rs 9.4 last year. So yeah, overall, a very strong financial showing.
But you flagged this earlier, and this is where it gets really interesting for me. That profitability surge massively outpaced revenue growth. Now, we know Avanti Feeds basically has two main businesses, shrimp processing and export, and then shrimp feed. So it's time to figure out which one was the real engine behind that 35% PAT growth. Because, as you said, the segment results tell quite different stories. A tale of two divisions, really.
They really do. And we have to start with let's call it the growth engine, the segment that often gets the attention, shrimp processing and export. This part of the business saw absolutely explosive growth in volume and revenue. It basically drove that entire consolidated top-line increase we saw.
Okay, define explosive for us. What kind of numbers are we talking about here?
Well, revenue shot up dramatically, 58.8% year over year. It reached Rs 3,712 million just in Q1 FY26. And the driver behind that huge number, it was almost entirely volume. Strong volume growth of 52%. They simply shipped a lot more processed shrimp out to the world. That volume push was also helped a bit by better selling prices on average, and, favorable foreign exchange rates didn't hurt either.
52% volume growth. Okay, that explains where the consolidated revenue bump came from, no question.
Yeah.
But here's the critical part, the real core of this deep dive, right? Despite shipping so much more product, despite that spectacular revenue number in processing, that division's profitability actually went down sharply. How does that work? Selling way more, but making less profit on each unit.
This is the absolute aha moment in these results. You nailed it. The EBITDA margin for the processing segment, it just collapsed. It went from 15% in Q1 of the previous year all the way down to a frankly concerning 9% in this latest Q1.
Wow, from 15% down to 9%. That's a huge drop, nearly cut in half. A 6 percentage point erosion in what seems like their high growth segment. What happened? What caused that massive margin pressure?
The source material is pretty direct about this. The main culprit was the imposition of countervailing duty, CVD, plus higher raw material prices during the quarter. So for our listeners, CVD is basically an extra import tax. It's put in place to counteract foreign government subsidies. What it means in practice is that Avanti's cost of selling shrimp internationally, especially into certain markets, went up sharply. They either had to eat that cost or maybe lower prices a bit to compete, and either way, bang, huge pressure on the margins.
Okay, hold on. If the processing margin got hammered that badly, down to 9%, how on earth did the overall company profit, the consolidated PAT, still manage to grow by that impressive 35%? That seems like a contradiction.
Ah, that's the power of absolute volume leverage. It's a key concept here. Even though the rate of profit, the margin percentage, dropped significantly because of that CVD hit, the sheer amount of product they sold, that huge 52% increase in volume, generated enough extra actual dollars in profit to more than make up for the lower margin rate. So think of it like this. They made only 9% profit, but they made it on a much, much larger base of sales. And that absolute dollar contribution was big enough to fuel that overall 35% consolidated PT growth. It really shows how a high volume, even if lower margin segment, can still drive overall company profitability.
Okay, that makes sense. It crystallizes the operational complexity perfectly. So focusing back on that high-volume processing business,
Yeah.
where is all this shrimp going? Does the geographical concentration introduce maybe another layer of risk?
It does. North America is still the dominant market by a long shot. It accounted for a massive 78% of all their processed shrimp sales in Q1 FY26. Asia and Europe are, much smaller secondary markets for them currently.
78% into North America. Wow, that is some heavy concentration. So does that mean the company is kind of overexposed to precisely the kind of trade risks we just talked about, like that CVD, especially if U.S. trade policy changes or tightens further? Is that concentration risk exactly why their recent move into Europe is so important?
You've hit the nail on the head. That's the perfect connection. That high concentration is a structural risk, especially when your main market slaps on duties like CVD that directly hurt your margins. So, yeah, diversifying geographically becomes almost a strategic necessity, and that's exactly what we're seeing play out in their latest corporate actions.
Okay, before we get fully into the strategy side, let's just quickly look at the other piece of the puzzle, the stability segment, as you called it, shrimp feed. How did the feed business do?
Right.
Did it provide that solid margin base that the processing side seemed to lack in this quarter?
The shrimp feed business, yeah, that's the dependable core, really. Revenue is actually down slightly year over year, about 2.7% compared to Q1 last year. However, and this is important context, if you look at it sequentially, compared to the previous quarter, Q4 of FY25, revenue actually grew strongly, up 19.7%. So that shows a pretty healthy recovery or rebound in domestic shrimp feed demand within India.
Right, so sequential recovery is good to see. And the margins, because it's kind of amazing, isn't it? The seemingly more mundane side, just selling feed, actually delivering much better margins than the glamorous export business.
That's the profitability anchor right there. The shrimp feed segment kept up its strong performance. Margins hit a really impressive 18.8% in Q1 FY26. So this segment provides that crucial stability. It's the high margin bedrock that helps the overall company results, especially when the more volatile processed shrimp export market faces headwinds like duties and raw material price hikes.
Okay, so let's put it all together. The financial picture is high overall profit driven by huge volumes in processing, but that segment is facing serious margin pressure. Meanwhile, the high margin rate comes from the stable domestic feed business. Now let's connect this financial reality, especially that 78% North America concentration in the CVD hit, to their very recent strategic move in October 2025. What's the plan? How does this address the risks and set them up for the future, particularly around global expansion?
Yeah, the company is clearly making a move to spread its bets, reduce that geographical risk and tap into new markets that might be less exposed to things like U.S. tariffs. So on October 20th, 2025, Avanti Feeds incorporated CLAEBV. It's a wholly owned subsidiary based in the Netherlands.
The Netherlands. Okay, that's not just registering an office, that's planting a flag, establishing an operational base right inside the European Union. A clear commitment.
Exactly. It's a very specific corporate action aimed squarely at getting a stronger foothold in that really important European seafood market. It gives them a new pathway, a diversified one, that should help mitigate the kind of concentrated risk they're facing right now in North America. They're basically building a presence there from the ground up.
And the timing here seems pretty good too, doesn't it? There are some positive tailwinds for the whole Indian seafood sector regarding Europe, correct?
Yes, absolutely. The timing is excellent. This European strategy aligns perfectly with a broader positive development for the sector. The European Union very recently gave the formal go-ahead for increased Indian seafood exports. So that regulatory green light creates a structural advantage, a tailwind for the entire Indian industry. And Avanti, through CLUXCBV, is positioning itself to really capitalize on that improved market access.
Okay, that paints a clear fundamental picture.
Hmm.
We've got the structural strengths, the big volume growth, but also these clear strategic challenges around margins and concentration, which they seem to be actively addressing now through diversification.
Yeah.
Let's switch gears slightly. How did the market react to all this? We had strong Q1 results, maybe with some nuances, and then this clear strategic move into Europe. What's the stock chart telling us, say, as of October 23rd, 2025?
Well, the market seems to like the story. It's been highly receptive, rewarding both the fundamental performance and that strategic clarity. The stock itself has strongly outperformed over the past year, up about 25.36%. And fundamentally, you have to remember, this company has now put up strong results for 5 quarters in a row. That consistency really builds confidence in their operational ability.
Right, consistency matters. And that recent news about the European subsidiary CELO XEBV, that must have added some fuel to the fire recently.
Oh, absolutely it did. The stock jumped over 5% just on October 23rd alone. That was driven by that positive news hitting the wires, combined with those broader sector tailwinds we mentioned. And technically speaking, the stock chart is showing really robust bullish momentum right now.
Can you give us a few technical specifics? What should people be looking at to confirm the strength of this move?
Sure. The price, when it closed recently at 720.80, was significantly above both its key 50-day and 200-day moving averages. That's a classic technical setup that confirms sustained bullish momentum. Plus, the stock just broke out of a consolidation phase. It was kind of trading sideways through August and September, and then it broke upwards out of that range. Importantly, that breakout happened on surging volume, which often suggests, bigger players or institutional money might be getting involved, adding conviction to the move.
Yeah, high volume on a breakout definitely adds weight to the rally, doesn't it?
Is there anything to be cautious about in the very short term, though, given how strong this run-up has been? Yeah, that's a fair point, especially for anyone thinking more short-term or tactically. While the momentum is clearly strong, the relative strength index, the RSI, it's gotten quite high. It was at 65.09 recently. Now, that's approaching what technicians call overbought territory. It doesn't mean the rally is over, but it sometimes suggests the upward move has been pretty intense, maybe a bit stretched in the short term, and could be due for a small pause or a pullback before potentially heading higher again. In terms of levels to watch, the next sort of technical hurdle, the resistance area, looks to be around the 800 to 820 zone.
Okay, that gives us a great map, the fundamentals and the technical picture. So let's wrap this deep dive up. Avanti put up impressive overall profit growth in Q1 FY26. That was largely driven by just sheer volume in the processing division, but that volume masked a critical issue. Those processing margins got squeezed hard, collapsing down to 9%, mainly due to those countervailing duties and higher raw material costs.
Right. And at the same time, the company is making a very clear strategic pivot into Europe with this new subsidiary, CELUX EBV. They're looking to capitalize on favorable EU export policies and, crucially, diversify away from that heavy North American concentration risk.
So given they've proven they can ramp up processing volume, and given this ambitious new European strategy focused on diversification, here's the final provocative thought for you, the listener, to chew on. The big question for Avanti Feed's valuation going forward probably isn't just can they keep growing volume. They seem pretty good at that. The real question is, can they execute this diversification strategy well enough to stabilize or maybe even improve those pressured processing margins, that 9% EBITDA margin we saw in Q1? Can they get that number moving back in the right direction via Europe?
Exactly. If CELUX EBV allows them to sell into the EU at better margins, or maybe just take some volume pressure off the North American market, allowing for better pricing there, then yeah, that processing margin is absolutely the key metric. It will really tell us if this current strategic push is succeeding.
That's the one to watch. And that's it for this deep dive. We hope you feel better informed and maybe a bit more equipped to navigate this evolving market.
Thanks for joining us.
We'll see you next time.